Since 2022, silver has hit 1.31% of gold, 1.31% of gold. It's set a dual top there. If you go through that, it's called a triple top breakout, and we think that's about to happen. When we run, and now I'll tell you why this is important in a minute. When we run the momentum of that spread, which is the chart at the bottom, where we measure the spread in relation to its 10-month average, you have similar looking picture, except that the momentum is already broken out over its downtrend line, and it's bumping the horizontal structure, whereas the spread is not. In other words, momentum is ahead of the spread. It's closer to a full breakout than the spread is. If that momentum breaks out, and it doesn't take much to do it between now and Friday, for example, end of the month.
Over the past several months, few analysts have tracked the shifting dynamics between gold, silver, and the broader equity markets with as much precision as Michael Oliver. His technical momentum work, often overlooked in mainstream commentary, has been quietly pointing toward a rare structural realignment within precious metals. According to Oliver, the spread between silver and gold is approaching a pivotal juncture. Since 2022, silver has twice reached 1.31% of gold's value, forming what he calls a dual top. A breakout beyond this level would complete a triple top formation, an event he believes could mark the start of a sustained and powerful acceleration in silver relative to gold. In his view, the momentum of this ratio has already broken above its long-term downtrend, signaling that silver's underlying strength is running ahead of its price. This analysis doesn't exist in isolation. It's part of a broader pattern that reflects growing stress and transition across global financial markets. Gold's relative performance against the S&P 500 has already reached one of its highest levels in over a decade, meaning the metal is quietly outperforming the largest equity benchmark in the world. And yet, few investors seem to recognize it. Oliver's data indicates that as this relative performance trend continues, capital flows will begin shifting more visibly out of the stock market and into gold. He describes this as the early stage of a long-term reallocation of wealth, one that tends to occur when confidence in financial assets begins to erode and investors seek tangible value. At the same time, silver's chart reveals something distinct. The metal has been consolidating for several years, underperforming gold for much of the post-pandemic period. Yet that very underperformance has built the technical foundation for what Oliver sees as a major breakout setup. The momentum structure, already in advance of price, suggests that once the spread confirms this breakout, silver's move could be sudden and forceful. If momentum leads price, then the implication is clear. The next surge in silver could unfold faster than expected, catching many investors off guard. Behind these technical patterns lies a broader macro reality. Central banks remain net buyers of gold. Real yields continue to fluctuate near pivotal levels, and inflation expectations are re-accelerating in several major economies. The US dollar's recent strength may appear to suppress precious metals in nominal terms, but structurally, Oliver's work implies that both gold and silver are transitioning into a phase of relative dominance. His outlook is not rooted in short-term price volatility, but in the cumulative buildup of momentum, what he calls the real signal beneath market noise. And according to his charts, that signal is nearing confirmation. In this video, we break down Michael Oliver's analysis of the ongoing setup in gold, silver, and the miners, why short-term volatility may be nothing more than a prelude to acceleration, and how relative performance charts reveal where capital could flow next. If you follow the precious metals space, or you're watching for the next major rotation out of equities, make sure to stay to the end. Don't forget to like, subscribe, and turn on notifications so you don't miss our next deep dive into the unfolding macro shifts driving this bull cycle.
Ignore the sell-offs and just look at a silly price chart of gold or silver. Just for example, back in, remember, silver was capped off at 35 bucks October last year and March of this year, and was in a one-year sideways range. And when it came back up through 34, we said, watch out, this time it's going to blow, but it's going to get more vertical. It's been a 50% increase in price since then. And 8 weeks prior to last week now, 8 weeks of higher highs, higher lows, 8 weeks in a row. I mean, that's highly unusual. Can it have a break where it takes out a prior week's low? Is that really a disaster? Now, gold, which is interesting, last week when silver took out the prior week's low, it refused to take out its prior week's low. So it had 9 weeks of higher lows. Today, finally took out a prior week's low. And it's the end of the world? Let it breathe, okay? It's an opportunity to buy if you're not already in. I does see protracted congestion, which is what we had April, May, June, July. You know, in 5 months, gold went dead sideways in about $150, $200 range. They kept selling, couldn't get it down. It kept coming back up. Finally, it took off. No, you're not going to have any more protracted congestion zones. You can have sharp sell-offs from time to time, and maybe somewhere in the middle of the next 6 months, you're going to have a pullback that actually involves a month, not just a week, okay? But right now, we're not at that point. The action last week, to a large extent, put us in a position where, in our weekend report, we suggested that was probably mostly it, okay? Now, the only problem was gold hadn't taken out a prior week's low, and so we finally did. I mean, that means we got under 4,000. Okay, it's back above there now. I think the cleansing we just had is probably about exhausted, and that when you flip back up, it's not going to take you 3 months to get back to the high. It might take you a week or so, okay? And I think when that happens, people say, well, golly gee, they did it to me again. They fooled me. We're in an accelerated mode, but there's certain other huge technical triggers that actually imply fundamental triggers that we included in our weekend report. And I don't know if you can show those.
Keep talking and I'll look for that.
Okay. On page 1, we had a technical situation. Yeah, here we go. Spread chart. There you go. Now, what this chart shows, if you can get even closer to it, it'd be good. If not, what it shows is gold going back to about 2013, plotted in its percent relationship to the S&P 500. Okay. The biggest bull market out there right now. U.S. market is the bubble. No other market in the world matches what we've done. Okay. Since 2009 low. But anyway, gold is in decline since its 2011 peak in price, but also relative to the S&P. It kept coming down, and here we start in 2013. And in 2015, late in 2015, gold made its price low, under 1,050. Well, that's when the spread dropped down to about 50%, that first sharp low you see there. And then you rallied up, okay, and you got distributed into, back down again, lost more ground versus the S&P, got down around 40% of the price of the S&P, then shot up again to that plus 60 level, got bagged again, back down to 40%, and then based for a couple years. And we broke out of that base early this year and ran up again where? To the green line that was developing as a structure. And sure enough, in April, when gold paused, as you noted, when we went sideways for multiple months, the spread backed off a bit, meaning gold lost some ground versus the S&P. And then when the recent reassertion of price back out above that 3,500 price level also drove the spread back up. Now, this spread reading you're looking at there was as of Friday, and it's probably backed off a little bit as of today. But at the end of this month is when we plot that final reading. Now, if you're at 60% or higher, and right now we were about 61 as of Friday, and there's gold divided into the S&P, it's 61% of the price. You're at one of the highest levels on gold versus the S&P going back 10 plus years. Meaning, in reality, gold is doing better than the S&P has for the last decade, but nobody notices that. But if you close credibly over that green line, which is now 1, 2, 3, 4-point trend structure, that is a massive relative performance breakout by gold versus S&P. Given the depth and the width of this base, and this is price versus price, so it's effectively a price chart, this has massive upside implications in terms of a shift in the money flows that go into gold and go out of the stock market. We're already seeing that. Gold's up a lot more than S&P over the last year, last 3 years even. So there's already been some money flow, but the average guy ain't in this market yet. And when this thing breaks out, we bet a couple things. One, gold's going to vastly outperform S&P going forward, probably for several years. It's going to be quite dynamic when it first comes out of here. It'll be like a whoosh effect. But you'll also start to get, probably a few months after this breakout, you'll start to get the headline type things that somewhat explain what is already happening. And we suspect those headline type things might be coming from the financial sector, where few people are looking. They're all looking at NVIDIA, okay? But anyway, forgetting the fundamentals, this tech to us, one, gold has been beating the S&P basically for the last 10 years, because it's the highest level in that period. And two, it's breaking out, meaning this relative valuation says it's only just begun.
As Oliver explains, the recent pullbacks in gold and silver are not signs of weakness, but a necessary breather after an extended advance. Silver, for instance, has climbed roughly 50% since breaking above its long-held cap at $34, marking 8 consecutive weeks of higher highs and higher lows, an extremely rare occurrence. Gold, too, has demonstrated resilience, maintaining 9 weeks of higher lows before briefly dipping below its prior week's range. According to Oliver, such pauses should not be mistaken for trend reversals. Instead, they often serve to reset market momentum and clear speculative excess. He argues that the current weakness likely represents an exhausted cleansing phase, one that sets the stage for the next sharp upward move. Oliver also highlights a critical technical development: gold's relative breakout against the S&P 500. This is not just a chart pattern. It's a reflection of shifting money flows within the global financial system. For more than a decade, U.S. equities have absorbed the lion's share of capital due to zero-rate policies and relentless liquidity support. Now, with gold outperforming the S&P by over 60% on a relative basis and pressing against a multi-point resistance line, Oliver suggests that this ratio is close to a decisive breakout. If confirmed, it would imply a structural reallocation of capital away from stocks and toward precious metals, an inflection point rarely witnessed in modern markets.
How likely, what's the probability that when you see a structure like this, that it does break through ultimately?
Yeah. Now, that's a point that we've noticed in especially our momentum work, is that when you build a structure that smacks you in the face with its clarity, like a spread structure or a momentum structure. Not so much price. Price is often illusory because that's what everybody sees. And when everybody sees something, sometimes it's not right. Okay. But on a spread, which very few, I've not seen this in any financial publication, okay, or on CNBC or Fox Business. We've been watching it for a while. And when we set that structure in April and then backed off, that in effect told us, boy, do you have a real clear structure. You don't build something like this to wave goodbye to it. You build something like this as a starting gate to engage something new. And that's what we've done. And sure enough, we're out above there. And if we don't get out above there on this month's close, I bet we'll be out above there next month. You don't build this kind of thing and fail at it again. Too many hits. You're going.
Okay.
Okay.
Okay, so based on your experience over the decades, when you see a structure like this, it is inevitable. It may not be right now, but it's inevitable. Okay.
Yeah, and it will be soon because this thing is ripe as a beast.
Okay.
And we know the dynamics out there are quite strong now. So this spread, when it breaks out, though, it does say one thing that most people aren't acknowledging. It's just beginning.
What are investors missing right now, and what do you expect for the miners over the next 3 to 6+ months?
Well, I expect them to go higher with gold, and I think they'll probably be a better performer over the next year or two than gold will be in terms of percent gain. But just look at GDX, for example. I mean, go back to 2011, it had a high in the 60s, okay? And then it dropped down, and where was it about 5-6 months ago? No, actually back about in June, okay? Was well below the old 2011 high. Heck, gold was way out above it already. And it was trading in the 40s, GDX. You went from 40 something to 85 a week or so ago. And you got a slam dunk $10, $15 pullback. Still way above the peak of 2011. You had a thin air pullback. Didn't break anything. It just says, golly, I doubled plus in a matter of handful of months, and I can't have a sharp pullback? Does that change the world? What do you think it's going to do? Go up every single month, every week? No, it's going to have pullbacks. And because you were in thin air, well above the 2011 high, which was like, We didn't even get to it this week when we pulled back into the high 60s. That's down to lower 60s. It's allowed to do that. It doesn't change reality. After all, it doubled plus in a handful of months. Can't it have a bad week? Okay. If you can't take that, you don't belong in these markets. Okay. You won't be able to catch the big move. We've had, silver dropped hard 1 week last week. Okay. And some follow through this week. So prices only dropped for 1 week. But when we run weekly momentum, which is also in this report, you made a high on weekly momentum 5 weeks ago. So momentum has been correcting, pulling back. What I mean by that is that when you measure the price of silver versus, for example, a 3-week moving average. So you have the rising price and the 3-week average is rising underneath it. When you slow the pace of the advance, even though it's still strong, at a lesser pace than the rise in the 3-week average, then you're going to get a momentum decline. Last week was week 5 down on momentum, and you got into what we call an oversold situation with only that one bad week, creating an oversold situation. Whenever we've seen that occur over the last year, there were like 3 or 4 instances of where similar action occurred. It was over. I don't care how bad that week looked. You didn't follow through in a sustained way after that. You started the turn. So even though it looked ugly, especially to price chart watchers, momentum says, no, you're through. You're exhausted on the downside. And I think that's where we are. And that's the nature of the sell-off you're going to be seeing in the future. It's not this 1 year wide range that silver had between May of last year and June of this year, where you could just draw a line through about $32 and it'd be above or below it for a whole year. Or gold, like 5 months, April through May, June, July, August, sideways recently. That's not going to happen anymore. We're now in an accelerated phase. And in particular, when this particular spread chart breaks out, it not only says is gold going to beat the S&P, but it means the money flow is really just beginning out of stocks into gold, which means what? The verticality we've seen in price lately in gold is just the beginning of that sort of verticality.
Where are we in your analysis in this bull cycle when you consider that the typical precious metals bull cycle does not last for just a year or two?
What might happen in the next year or two might be awesome, though. I think we're going to go into a new reality. Go to the next page, if you would. This is another spread that we're watching we think is enormously important. This only goes back to 2020. If you recall, in early that year, silver about doubled in price, went from like $15 to $30 in 6 months. A lot more than gold went up. So this spread went from 0.9% to 1.5%, which is, huge move. Silver doubled, gold went up like 40% or so during that surge. And then what happened after 2020, price-wise, late 2020, silver bumped 30 area, and it went sideways to down while gold went sideways. Okay, so on a relative basis, silver, that black line there, the black zigzag, is the price of silver divided into a price of gold, ounce per ounce. And silver went from 1.5% of the price of gold down toward 1% of the price of gold. So it's been an underperformer for all those years, though it's been going up in price, admittedly. Now, in the last handful of months, you can see that spread has shot up again, the top chart now. And there's a black line, a downtrend, that we bumped. And this month, we're backing off from it. So we've got a 3-point trend line there to focus on going forward. But we also have the green line. What does that say? That's a level where since 2022, silver has hit 1.31% of gold, 1.31% of gold. It's set a dual top there. If you go through that, it's called a triple top breakout. And we think that's about to happen. When we run, and now I'll tell you why this is important in a minute. When we run the momentum of that spread, which is the chart at the bottom, where we measure the spread in relation to its 10-month average, you have similar looking picture, except that the momentum is already broken out over its downtrend line, and it's bumping the horizontal structure, whereas the spread is not. In other words, momentum is ahead of the spread. It's closer to a full breakout than the spread is. If that momentum breaks out, and it doesn't take much to do it between now and Friday, for example, end of the month.
From a technical standpoint, Oliver's confidence in the inevitability of this breakout rests on structural clarity. When a momentum or spread structure becomes so distinct that it smacks you in the face, as he puts it, it rarely fails. The silver to gold spread, the gold to S&P ratio, and the miners charts all display this type of unmistakable setup. Momentum precedes price action, and in each case, the indicators are aligning for a sustained move higher. Even the recent sell-offs in mining stocks, despite record-breaking Q3 earnings and projected historic Q4 performance, fit the broader pattern of temporary dislocation within an ongoing bull trend. GDX, for instance, has doubled within months, yet remains far from its historical highs. Such corrections are natural within what Oliver calls the thin air stage of a bull market, when price gains have outrun sentiment, but the structural trend remains intact. What investors often overlook is that these momentum patterns are not limited to chart dynamics. They correspond with deeper macro forces. Global fiscal expansion, rising energy costs, and geopolitical tensions are reshaping the narrative around hard assets. Electricity shortages and social unrest in key industrial regions, combined with central bank gold accumulation, all feed into a broader cycle where tangible value begins to outperform paper assets. Oliver's projections imply that this process is only beginning. The whoosh effect, as he describes it, represents not only technical confirmation, but also a psychological tipping point. When retail capital begins to recognize what institutional flows have already anticipated. This setup recalls the great bull cycles of the past, the 1970s, the early 2000s, and even the 1930s through the miners' proxy performance. Each began with skepticism, matured through volatility, and culminated in multi-year exponential gains. Today, gold's breakout above long-term relative resistance, paired with silver's nearing triple-top breakout, signals that we may be entering a similar multi-year phase, one defined by accelerated money flow from overvalued financial assets into undervalued hard assets. If Oliver's models are correct, the current pullbacks are not the end of a rally, they're the ignition sequence of a much larger move. As momentum realigns and relative strength shifts, the window for positioning in precious metals could be narrowing. Whether you're a long-term investor or simply watching for signs of the next major macro rotation, this is a critical moment to understand what's developing beneath market noise. If you found this analysis insightful, make sure to like this video, share it with other investors tracking the metals market, and subscribe for our upcoming coverage of gold, silver, and the miners as this next phase unfolds. Thanks for watching.